The Federal Reserve met on Wednesday, zero policy shifts. Is that true though? They did do something that I think a lot of people just completely overlooked. And this is the beginning of something that could be a massive move. It involves the carry trade. It involves the money supply. And this is the beginning of something that I believe is going to shift the entire world economies, specifically the US economy. Now, what was the policy shift that they did? The Federal Reserve has been actively reducing its balance sheet. Now, the Federal Reserve's balance sheet, of course, they ballooned that because of COVID. Then they started reducing it once the U.S. economy got on its feet, especially when there was inflation. They jacked interest rates up. They started reducing their balance sheet. They are now reducing it at a lower pace. Still reducing it, but at a slower pace. They've been kind of inching that closer to what is now more and more policy shifts. But there's something else going on. Money is starting to leave the United States, and the rate of growth of the money supply is flattening out. This would mean that if money starts moving at a hasty pace out of the United States economy, we will see shifts in the dollar, we will see shifts in interest rates, we will see shifts overall in the US economy. This could be the beginning and sort of the symbol of what's going on and how the economies are going to evolve from here. Now, there are places that you could invest in right now. I am shifting to Europe. And I'm shifting into the Japanese yen. I have a few trades that I'm going to break down towards the end. I'll show you the charts that I'm looking at there. But I need to kind of build a story as to what's going on with the U.S. economy, why the Federal Reserve has made a shift that might be more significant than lowering interest rates. Let's jump in. First and foremost, thanks so much for following along. I am shifting things a lot, not doing nearly as much YouTube content and shifting over to my Substack. Here are the links, dhtaylor.substack.com or dhtayloranalysis.com. And what I'm trying to do is de-emphasize YouTube, which is genuinely not that great, versus Substack, which has been a great platform for me, and I'm seeing huge numbers grow. There are links down below. Thanks so much for hitting those links and subscribing. You can get my email. It's free. Now the beginning would give you the video. So if you're watching this on YouTube, you can get this email directly to you to stay abreast as to what's going on in the content I'm producing. If you are a paid subscriber, you get all the information down below, plus the new chat section that I have going on. That's where I put my actual trades. I'm trying to do that in a real-time basis so that individuals can see and follow along as to what I'm doing. If you are finding this on Substack, again, thanks so much. Same exact criteria. I break down economic indicators and how they affect the stock market. So again, my Substack numbers are leaping. Thanks so much. Appreciate that. Let's jump in. This is the Federal Reserve balance sheet. And you can see the big jumps. Of course, 2008, the financial crisis was one of the big jumps that we've seen, where the Federal Reserve came in, and I think they did 3 overall quantitative easing processes that got them to the point where you can see the balance sheet that they did. And we were starting to produce results, and then all of a sudden COVID hit, and you could see the big jump in 2020 when the Federal Reserve immediately expanded its balance sheet. And specifically what they did was the federal government was the stimulus checks. They were creating new products for stimulus checks for U.S. consumers. Federal Reserve stepped in and just consumed all of it, as much as they could. What they did when they did that was they invented brand new money. And you could see that their balance sheet ballooned significantly. By them doing that, by the Federal Reserve stepping in and to do that, what happened was financial institutions and other investors did not have to sell something to buy this new debt that the federal government was creating. So by the Federal Reserve inventing new money, this allowed other investors to remain in those investments, and it helped the economy move forward. Then we started getting inflation, which was a product of many things. First, the supply chain broke down, of course. We all know about that. Second, boy, are we getting gouged. We're getting gouged on eggs. It's all, from my understanding, from some of the studies that are going on, this is all fictional. We are simply getting gouged. Sure, prices could go up, but why would a company not get as much profit as they possibly could? So they are. So there were a lot of benefits to this, but we saw inflation and the Federal Reserve needed to shrink its balance sheet and kind of contain price pressures and the money supply. Now, this right here is the actual growth rate of what you saw there. Sure, there was a big leap up in March 2020. On a year-over-year basis, the jump was extraordinary. But since the Federal Reserve has been reducing its balance sheet, you can see the pace at which it's doing the change from 1 year to current. The Federal Reserve is now reducing that pace of decline. So we're looking at about negative 10% right now. We might see, say, negative 5%. Not exactly sure where that's going to come in, but the shift is going to, they've been doing this. You can see that they've been doing it for some time, but they're going to do it even more so. And this is what's really kind of the alarm bell for me. Now, this is commercial bank deposits. So all that money that was created turned into deposits into bank accounts. Anybody who got a stimulus check deposited it and then spent it. Now here's the thing. Let's say there's a fictional economy and I've got $10,000 and I deposit that into a bank account. Now all of a sudden the money supply is $10,000. You walk into a bank and say, I want to borrow $10,000. Sure, we just happen to have $10,000 we can loan out. So they do. All of a sudden, this fictional world now went from a money supply of $10,000 to $20,000, or a 100% increase. If a third person, you deposit that money into your bank account, spend it, it gets distributed throughout the economy. But then what happens next is someone else collectively borrows another $10,000. The fractional banking off of what you deposited. Now we're at a $30,000 money supply. So you can see how this starts to just kind of keep going and going and going. Of course, there's credit risks and things like this, and there are some limitations, but this gives you an idea as to why commercial bank deposits moved higher. This is the pace of commercial bank deposits. It's not quite normalized. It's low. It's still positive, but it's not there. And because the Federal Reserve is reducing its balance sheet, while at the same time commercial bank deposits are not moving forward at a fast enough pace, the Federal Reserve is getting a little concerned. And they should, because all this isn't really the issue. Now here's a look at the M2 money supply, and I've been bringing this up on a regular basis with my content over the past couple weeks and months. It's flatlined right here. And we're below median, and you could see how, yes, the Federal Reserve is reducing its balance sheet. Commercial banks are increasing, of course, but there is some limitations, and it's not quite hit that median level. And this is something that I'm one of my go-tos, because if the money supply is growing at a fast pace, the economy will follow suit. Businesses will borrow money, build buildings, hire individuals, and those newly employed individuals will go out and spend money, and it continually moves the economy forward. All right, let's take a look at the dollar yen. Now, US dollar versus Japanese yen. First, for those who haven't been following me for too long, I used to be an FX hedge fund manager. I managed a fund that dealt entirely in FX, most specifically, options trading in FX. So I have a very strong background with foreign exchange. Now, here's the thing. You need to understand interest rates in economies of the various majors: Japan, Australia, Canada, United States specifically, Great Britain, Europe, and of course Switzerland. And it's an exhausting process where you're constantly looking at economies specifically because of interest rates. Now, as you can see, all the way back in 2022, what happened was once interest rates started to move higher in the United States relative to what was going on in Japan, the US dollar rallied versus Japan. Now, here is what the US 10-year Treasury yield looks like versus the Japanese government bond 10-year Treasury yield. They don't call it Treasury. There's a differential between here. Now, interest rates in Japan were so low, feasibly, you could go to a bank inside Japan and borrow $1 billion for 0.5% interest. Now, we had some relatively high levels of interest rates here in the United States. You could borrow that $1 billion in Japan, sell the Japanese yen, buy US dollar, then deposit it into a bank account here in the United States and get 5.5% or some other investment, whatever it may be. But your spread on that, the difference is 5%. Theoretically, you would do this all day long. All you have to do is call up a bank in Japan. Yeah, give me about $10 billion. Call up your FX broker. Go ahead and buy US dollar, 10 billion selling Japanese yen, deposit into any institution here in the United States, maybe US treasuries, maybe corporate bonds, whatever it may be, and earn that 5% difference. The only thing you had to do, of course, was sell Japanese yen, buying US dollar. And as we can see in the previous chart, let me go ahead and switch this back. This is Japanese yen. You can see that the Japanese yen, of course, continued to move lower versus US dollar. Dollar moved up versus Japanese yen. That trade is breaking down. On the one hand, the Federal Reserve is starting to lower interest rates because the economic growth is slowing modestly, while at the same time, inflation is in check. Simultaneously, the Bank of Japan is raising interest rates. Now, there's two main ingredients to make this trade work. First, you need that differential, and you need the differential to continually widen. It is now shrinking. Second thing, predictability, stability. Since the beginning of this year, I think we've lost a great deal of predictability and stability, while simultaneously we have a Federal Reserve that is shifting to the downside, lowering interest rates, pausing for the moment, but will resume lowering interest rates over the course of the remainder of the next year. This trade is breaking down. But think about that process. You called up a bank in Japan and you said, let me borrow $100 billion. You deposited that into the United States and banks put that to work. Not only that, there was also the stimulus which perpetuated the economy. So we have all this money flowing into the United States, and this had grown the economy. Now, however, this trade is breaking down, the differential is narrowing, and investors are leaving. We are not in a pro-growth environment economically here in the United States anymore. Plain and simple. Given that, and plus there's a considerable amount of lack of stability. Now, if you've ever seen the stock market falling sharply in any period of time, one of the things that we'll do is investors will get out of the stock market and they will rush into treasury bonds, which would narrow that differential just on that day alone. Now, granted, a lot of times when we see selling, we see buying the next day, whatever it may be, maybe a week, 10 days later, but that money will leave the treasury market and go back into equities. During that period of time, however, when investors rushed into those treasuries, price went up, inverse relationship, yield went down, that narrowed, FX, the dollar sells off. You can see that since the beginning of this year, we have seen some selling going on in Japanese yen, US dollar yen. All right, moving forward, I expect this to keep going a lot. This is one trade that I am putting on, but I am using some, while I used to be a FX trader, straight into the FX market, I'm going the easier route because I simply want to sleep at night. Now, FXJ ETF is the Japanese yen ETF fund. And we're looking, it's about 61.5 right now. I think we're probably going to see some stability over the next couple days. I think the powers that be in, or the power that be in Washington realizes that he's rocking the boat a little too much. Stock market has fallen too far and will probably back off some of these policies. Shifts that we've seen coming in at muzzle load fire velocity, and we'll see some buying back in the stock market. Probably see the US stock markets moving somewhat slightly higher, and individuals will exit their positions that they rushed into US treasuries. So I could expect FXJ ETF to move downward some amount for now. But there are other factors going on, and this is also something we're seeing. Not only is the United States of America basically being removed from the globalization aspects, we're probably going to be removed from Europe. And that's something that I've been paying attention to. VGK ETF is one of, and I'm looking at two, FEZ is the other one, and I'm going to kind of break them down and kind of figure out which one's better. This one, VGK ETF, is it's a European index similar to the S&P 500. And as you can see, since about the very beginning of the year, they've diverged considerably. Now, Germany itself, what's going on there? Germany just got permission from the EU to go beyond its percentages for debt to GDP ratios or deficit to GDP ratios. They're taking on more deficit spending in order to kind of take up what the United States is being removed. I expect we will probably be taken out of NATO. I fully expect that. Number one. Number two, U.S. troops will be removed from Europe. I absolutely expect that to happen. I would be surprised if it didn't. Europe is getting ready for that. Germany just announced, something like $1 trillion expenditures for infrastructure and defense. And as you can see with VGK ETF, European bourses, indexes are moving higher, whereas the S&P 500 has sold off some 10% in just 4 weeks. So on the one hand, you have these interest rate differentials where all this money had come into the United States. That trade is breaking down. That money is leaving the United States. Investors will seek higher returns. And where are we getting that relative to the United States? Certainly Europe is doing a good job. So we're going to see this vacuuming of money out of the United States. Now, we still don't have enough evidence that there is currently a recession or that we will enter a recession. But the more I look at it, it's a totality. If you look at one particular economic indicator, you say, yeah, we're still moving forward. But that's just one. What's going beyond that one is that there are 10 other economic indicators that are just taking body blows to the economy. My take on what the Federal Reserve did is an acknowledgement that the money growth rate is slowing, declining, and that they can't participate in that or perpetuate that any further, that they need to ensure that the money supply continues to be able to breathe and create more economic opportunities here in the United States. Meanwhile, there's a vacuum cleaner when it comes to money here in the United States. The Federal Reserve will eventually have to lower interest rates, and that lowering of interest rates the long end of the yield curve won't be affected by what the Federal Reserve does up front. Instead, the short end of the yield curve will fall, but we're probably going to see a pretty decent sized deficit with an economy that isn't going to take in as much tax take, more deficit. Now, I just saw the 20-year Treasury. I get an email from the Treasury with the auctions. I get 10 a week. The 20-year selling discount to par. Now I have a video on bond investing. If you're looking for that information, that's something you need to really kind of pay attention to. So basically, there is an interest rate that investors are getting for lending money to the United States, but they're basically saying, sure, I'll give you 4.5%, or I'll take 4.5% for this $1,000, $100. Just give me a better price. Well, it's kind of the same thing as a higher interest rate. So yield to maturity is favoring investors. Prices are coming in for the 20, coming in at, say, 96. They're basically, investors are looking for pretty steep discounts to par. So we're seeing money being removed because the carry trade is breaking down. We're seeing money likely flowing toward Europe. Now, in my Substack newsletter, I broke all this down, and I do show the euro, British pound, and how they are elevated and moving higher versus the US dollar. So it isn't just the Japanese yen. The Japanese yen just happens to be very low relative to the US dollar, whereas the European currencies are already pushing higher and have been moving so over the past few weeks. FXI ETF, China. Believe it or not, they are significantly outpacing the United States. FXI ETF versus SPY, you can see that on a relative basis, there is a lot of growth here, potential. Honestly, it looks like these individuals in Washington want nothing to do with science, technology, and the advancement and competitiveness for U.S. BDY just announced, 1,000 gigawatt charging capabilities for a vehicle of $20,000 to $30,000 versus, say, a Tesla, which is 2.5 times pricier and a lot slower. You can basically get 350 miles in a charge in less than the time it takes to fill up your gas, which was a huge hurdle. All right, this represents investment in technology. And the current administration wants nothing to do with that, basically. They're basically saying, you know what, the United States of America and nothing else. We don't care about the outside world. We don't care about technological advances. Okay, but what about you? What about me? Where am I going to put my money so I can make it grow relative to what might happen here in the United States? And that's what my channel here on YouTube or Substack newsletter is all about. Breaking down economic indicators, looking at these bigger trends to show you that there are opportunities. Unfortunately, on a relative basis, it's no longer the United States. Make certain to follow the links down below for my Substack newsletter. I do have in my chat, it's on the main page for the website. You can just at the very top, they've got the lines there for the chat. You can subscribe to my newsletter, take a look at my chat for my actual trades, and I'm going to be continually updating those as time goes by. We'll see you in the next video.